This is Mike from Key West, Florida, with another educational video from Vant Trading. What I want to talk to you about today is how we trade the markets that are in a correction. Trading is like gambling, and it's all about the odds. What separates trading from gambling is the structured approach that allows the trader to become the house. Unfortunately, the majority of traders are out there gambling. And as we know from Vegas, the house always wins. Successful traders use a structured, disciplined approach to put the odds in their favor. Now, successful traders also understand how important the psychology in the markets is. See, the success formula for trading is 80% discipline and psychology, 20% technical skills. But what you see a lot of novice traders doing is paying their money and spending their time looking for that holy grail that's going to allow them to make money. And so what unsuccessful traders do is they trade their emotions. They trade to get something, to get an emotion, and they overtrade in the process. Successful traders only trade when they have an edge and the odds are in their favor. Now, they will wind up taking a lot less trades, but the percentages are always in their favor. Now, there's two sides to fear and FOMO. FOMO is the fear of missing out, and it typically causes novice traders to buy at the top. Fear is the fear of loss, and it causes a lot of traders to sell at the bottom. So don't get caught up in the fear. But the key thing is humans have emotional responses. We're emotional human beings. And the problem is a lot of people feel that you have to take emotions out of trading. But the problem is because we are human, you can never get rid of your emotions. What successful traders do is they create a structure so that they can control their emotions and recognize their emotions before it affects their trading. Now, what I want to talk about is, how do you get an edge in this type of market? And what I want to explain to you is what the process we go through to get our edge that works really well on our trading floor. The first thing we look at is the health of the market. So we're going to look at the market internals. And we have a lot of different things that we look at. We look at the tick. We look at the tick cumulative, which we're looking to see is institutions buying, or are they not buying? We look at the NIMO, the McKelligan Index. We look at the advanced decline line. And then we try to gauge and look at the fear in the market. And we look at the VIX and the VXX, which is based off of the VIX. We also take a look at relationships. So we look at what are the generals, who led us up in this market, who's going to lead us out. And then we also look at levels, support and resistance. Where, after you have a bar like we had yesterday, a large red bar that took us to the bottom of our range into support, we want to know what was the prior day's low, what was the weekly low, okay, and what's some of the major daily levels, because these are all going to be signposts to kind of tell us and give us a gauge for where the market may be heading. And then, of course, you're going to want to know, is there any market moving events? Well, we knew today that Powell, Fed Chairman Powell, and Treasury Secretary Mnuchin was going to be speaking in front of Congress today. So we knew that was important to have on our radar, as it could be a market moving event. Then the key is to look at price action. Okay. This is probably one of the most important things that you can remember. Trade price action, not your opinion. Your opinion will not be based out of fact. It's going to be based off emotion. And really what you got to do is let the market tell you where it's going. Okay, it's your job to interpret it, not to force an opinion on the market, because the market, quite frankly, doesn't care about your opinion. And 90% of the time, you're going to be wrong anyhow. So let the price action tell you, and then know what kind of market you're in. Okay, your P&L will tell you what kind of market you're in. What you use, the trading style you used even 30 days ago, okay, is not the same style that's going to work in this market. okay? And I'm sure your P&L has kind of showed you that. So what you got to know is what kind of market you're in. And we know we're in a market that's in a correction. So for us, all trades are going to be short-term, scalp position only. Okay, we're not going to be entering in any tier trades. We're not going to be entering in any longer-term positions right now because we are day traders. And you want the market. You got to understand the market is guilty until proven innocent. Brian Shannon from Alpha Trends, he kind of has coined that, and he's a really good guy to follow. And it's true. You want the market to prove to you that it is better and it's back into a trending area, so then you can change your trading styles. What I want to talk about next is one of the edges that is commonly overlooked, and that is the relationship edge. Typically, when I talk to people about, relationships in the stock market, they typically think I'm going to talk about the relationship of stocks to bonds, or the inverse relationship from interest rates to bond prices and TLT, or the inverse relationship of yen versus the stock market, if you've been trading for a while. But what I'm more concerned about in this market, and what I'm more interested in, is the market generals. And again, remember, we talked about it. What were the stocks that really were the generals of the market that led us up to begin with? And really, in this market, there were two of them. There were Apple and Tesla. Now, Apple, I kind of use as, because it's more institutionally traded. I use it for more pricing and levels. And Tesla is more from a sentiment standpoint. When you talk about the Momo trade and momentum, well, Tesla definitely hits that sentiment. So what I want to do now is I want to switch and take a look at the markets, look and go through a checklist and see how did we trade the markets today. So let's take a look at a daily chart of the SPY. If we look at the daily chart, we started this pandemic in February, towards the end of February. We had this deep sell-off all the way down to what we now call the March lows. Okay. Then since then, throughout the summer and the spring, we've been, grinding right back up. And I wouldn't even call it grinding. I would call it just ratcheting and rocketing back up, all the way up through these levels up to make all-time highs in the SPY and on also the Qs. So pretty strong price action. And if you look at the price action on the daily chart, really, you don't see too many pullbacks. Maybe when we got up here and started going, we saw a little bit of a pullback here, came up, and as we touched and hit the 200-day EMA, we hit a pullback right in here. And then as we came up to the level, which I like to call the scene of the crime, and the scene of the crime is the point at which we fell from, right? Well, we hit that level, and of course, predictably fell all the way back down to the 200, to the 50, excuse me. And we had a little pullback down in here, right? But then since then, really, maybe a little pullback here, but we really ratcheted up. And now if you really zoom in here, this top right up in here, it almost looks like a blow off top, doesn't it? And then we've pulled back ever since. Now, when we were looking at this initial descent, there's two things you got to look at. One is, are we going to be in a pullback or are we going to be in a correction? Okay. And, there's really not much difference, I guess. It's just stuff that people make up. But to me, a pullback is typically around 5 to 6%. It's a nice dip buying opportunity for you to readjust some positions, take some profits, and to get back in at a lower price. But the problem is when a pullback becomes a correction, and a correction typically is 10% or more, upwards to 20%, depending on the type of market we're in. So if you look here, these are the levels that we drew, right? And so when we fell down back down to this area before we, before we hit this gap zone, we kind of looked at it, and this was about a 6% drop. So we kind of dropped down to this level, dropped down to the 50 EMA, and found some support. And you got to like it. It's just really strong. When you have an EMA and you have a really strong daily level occurring at the same spot, that typically is pretty strong and a good indication. So we found some support down here. And at the time, it looked like we were going to create a little bit of a range in here. And really, we were trading as if this was just a pullback. Now, what we have here is the 9 EMA and the 21 EMA. So obviously, through this pullback, we kind of found that support to 50. And but we were kind of below the 9 and 21. So it's a pullback, and we kind of popped above right here, and it looked like we were going to be in the go zone, but got rejected right away. So once we fell back down and fell through this support zone and broke the 50 and broke this major trend line here, then this now took us into correction mode. And matter of fact, when we closed right here, we said it on our afternoon show. We said, look, we're fully bearish right now, and any really gains or legs up, we are considered sell opportunities, and that's what we got. So we profited pretty good because we knew what kind of market we were in. Still keeping short-term trades, and it looked like here, people started getting excited. I saw people buying Apple, and a bunch of traders, thinking that the low's in and we're going right back. And then, we had this bar yesterday, right? And if we can zoom in here, you can see we kind of came up. The 9 had really fell down to here, came up to the 9, got rejected, and really came crashing down through this level. And if we scroll out, this level is the scene of the crime, which is the important level that we're really worried about. Kind of crashed back down here, and this is typically when a trader sees an engulfing candle like this, that typically you see follow through on the next day, and then the third day you see a little bit of a bounce back. So we were going in today fully expecting some kind of weakness. We got that weakness in the pre-market, which kind of helped us a little bit. Now we did, if you look in here, and I talked about know our levels, right? So I'm going to zoom in here. We got 2 red lines. One is the low for the prior day and the low for the week. So they were 2 important levels that we were looking at as we were trading this stock today. Again, signposts to give us an understanding of where we are. Now, where do we think, looking at this chart, think the market could go? We feel that the market's destined to come down to this 200-day EMA. So right around this 313 area, we would not be surprised. We also wouldn't be surprised if we bounced back up into this correction zone and then kind of chopped around a little bit before we did fall back through. That would be a little bit more positive action. But what I want to do now is I want to switch, okay? And I want to share with you the intraday chart for the SPY. This is the intraday chart of the SPY right in here. And as you can see, you can kind of see right here, this is the pre-market action, this grayed out action. 8:30, we had continued claims come out, and claims were a little bit worse than expected. And so the market sold off into those numbers, created a new pre-market low, and then bounced up just as we were getting ready to go into the market open. Now, there's a couple things. Remember, it's your opinion, not price action, because I saw so many people in here saying, oh, we got to get short, get short, get short, get short. Well, that's an opinion, and that's based out of fear. It's not based off of price action. So what happens is, obviously because of the type of market we're in, the first 15 minutes really we're kind of sitting on the sidelines, let the price action, because you have what's called price discovery going on. And this is not the market to get chopped up into any type of price discovery. And if you see this dotted orange line, if you can see this, this is the opening print. And that is one of the most important indicators that we use as professional traders to get a gauge for where the market's going. So if we look in here, we can really see that the market came down, tested, broke their view up first off the opening print, failed, came back down, tested this pre-market low, and then, textbook went right back up through the through VWAP, okay, up through the opening print, up to the point of control for the pre-market, okay, and the point of control is where it's, you know, below it, the bears are in control, above it, the bulls are in control. So they took it up through the point of control, made this 15-minute high here, which is kind of highlighted right here, found support at this level, which is a major daily level, and then rocketed up through the pre-market high into that first low, which is the weekly low that we were talking about. Okay, so interesting, right? Interesting. Came right back up through that first low, hit it to the T, and then failed dramatically, fell back through, okay, through this other daily important level, and fell back right down to the opening print, found support, made a higher low, got up to this level, failed, found support at VWAP, another higher low, and this is pretty much textbook action to take you right up into yesterday's lows where we failed again, came back down to the pre-market high as support, and then we went right back up and charged right back through. Okay, this is as textbook action as you will get, and if you followed the price action, then you really would have made a killing. Now, there was, though, a couple indicators that really showed and gave us a huge edge, because we made a killing today trading, and I just kind of want to show you this relationship indicator. Let's take a look and see how Apple performed versus the SPY. Now, I don't know if a lot of people realize this, but if you use Thinkorswim charts, you can overlay another security on a particular securities chart. So what we have here is the intraday chart of Apple. That's our market general for price levels. And then overlaid this pink line here is the SPY, okay? And I think actually maybe the SPX, same thing. Okay, so interesting divergences that we saw today. And this, again, this is stuff that a lot of people don't look at. And if you would have looked at this, it would have given you a huge edge today. So if we can zoom in here on this first action in here, you know, if you look, Apple, which is the green bar and red bars here, Apple from the opening print pretty much went straight up, okay, went straight up, came back, found support at VWAP, and just powered up, okay? But at the same time that Apple was going up, look what the SPY did, okay? So the SPY, which is this purple line, was driving down as Apple was going up, making a new low while Apple was busting out of its range here. So that's key divergence number one. And when we saw that, this was our signal that the general was leading us out, okay? And we bought calls in here and got this nice action all the way up on the SPY. And we got it at a price that really, from a risk to reward standpoint, is very good. Now, does this guarantee that this trade would work out? No, not at all. Again, what successful traders are looking for is put the odds in your favor. And if you look at this, this is a nice, you know, because right here, okay, if we were to buy these calls and get in right around down here on the SPY, you know, if the SPY was to go even lower, then, you know, our stop loss, very small. We lose a very little amount, and this would make this whole thesis pretty much on Apple mute. And so, you know, we got the turnaround we were looking for in the SPY. We bought the calls, very good risk to reward ratio, and this was a huge, huge win for us in the SPY. So that was divergence number one with Apple. Divergence number two with Apple was right here in the middle. If you look here, the SPY, as Apple came back down and, you know, was pulling back right around the 1030 area, Apple really found support at VWAP, which is really important for you to understand. Because if we go back and we look at the SPY, right, at the 1030 area, the SPY broke through VWAP, you know, and was weaker than Apple. So right here at 1030, the SPY breaks through VWAP. But when we look at Apple found support at VWAP at a pretty higher level. So it didn't retrace as much as the SPY. So this was tell number 2 to possibly get in for another run up, which we did. Then right here, if you look, Apple, okay, is making new highs right here. Okay, Apple's making new highs. The SPY, you know, you can see the high of the SPY. The SPY was not making new highs. So following the same thesis, this was another, on this pullback here, another good opportunity to buy some calls for a low risk trade. And of course, it paid off beautifully on that. So that is relationship trading. You know, obviously what you're looking at is you're looking at all the other market generals as well. And, you know, you got to make sure price action confirms. And if it doesn't, you get out and, you know, again, being a disciplined trader. Now, we had one other kind of tell in the afternoon. So I was trading, you know, I was trading Square today. Square is a really, first off, when a market is in a correction, okay, what you want to do, okay, what you want to do, okay, is that you want to make sure that if you're dip buying stocks, you're dip buying stocks that are strong stocks, have a good story, okay? It's got to have a good thesis. So don't dip buy weak stocks. Okay, so Square came out this morning with a couple analysts came out with upgrades, higher price targets. One came out with a 185 price target. So I knew Square was going to be a pretty strong. So we traded Square today in a really nice trade along with our SPY trades today. Okay, really nice dip buy. But obviously, since we had Square on our screens and it's one of the stronger stocks, we kind of noticed something on the floor. And again, this is relationship trading. What we noticed was Square had a nice large, almost, you see this, you know, spinning top up here and a nice large engulfing candle coming down, right? And the spot, and then they had 2 other candles. So it was in a downtrend, broke this 22 EMA. And what we noticed was SPY, however, was starting to drive up to a higher high. Okay, at least coming up to this top level. So seeing this weakness, when you see weakness on your charts, okay, and it will show up in level 2 as well. We got in on some puts here. And again, this was a nice trade on the SPY as the SPY followed this leader down. And again, you know, it's, you know, what stocks to use, what stocks not to use as far as relationships, you know, you kind of get a good feel for it. But this is something that's really important when you're looking to trade. You know, relationship trading really has helped us today make some really good trades. So what I want to do now is I want to go and I want to give you this checklist, right? I want to give you this checklist. Let me pop over here. So this is the checklist here. You know, first off, you know, look at the market internals. What are the market internals? You know, are they in your favor, not in your favor? And if you're confused about market internals, go check out the video, educational video, How Mike Trades SPY. I go in depth on how we use market internals to trade the SPY. And then look at your levels. Right? What's the prior day low? What's the weekly low? And we saw, when we saw the SPY chart, right, it went to those levels to the T. So if you don't have these levels on your screen, you're doing yourself a complete disservice. So if we go back to the SPY chart here, you know, here was our weekly low, here was our prior day low, and it went up there to the T and fell right back down. And if you look here, the opening print, really important, right? And then we drove right back up and hit the other low to the T and came right back down and found support. So knowing these levels are really important, really important. And you give yourself a nice little edge. Okay, know what market moving events there are. Okay, Powell was speaking before Congress. You should at least have an ear on it, at least know, hey, you know, keep your eye on Twitter, on any news services. Make sure you know what's being said. And then, look at the price action. I talked about the opening print. Opening print is sort of like a market floor technique that I've used from trading. I used to trade at Lehman Brothers and Wall Street. And, when the a stock blows through its opening print to the downside and then comes back through it, it's a great indicator, a good stop sign for, hey, we may have a reversal on our hands. Again, may is the key word. And then also, use multiple time frames. Okay. A lot of you I see are out there trading off the 1 minute chart. You're trading, you're not even looking at the daily chart. You're not even looking at the 5 minute or 15. You should look at all time frames and have a good thesis to make sure that the odds are in your favor. And then have your playbook, know the market you're in. Okay. Know the market you're in, short-term trades only in this market right now. And then you see right there how relationships really told the story for our trades today. And we use relationship trading a lot to base on what we're doing. We use it for rotations, have market leadership change. Are we going, are they buying up the value stocks, like we call the trash stocks? Are they back into momentum? What's strong, what's not strong? Understand your relationships. And all this stuff is meant to give you an edge in your trading. I hope this video helped. And follow us at our 1 o'clock show. We have a show on YouTube at 1 o'clock every afternoon, and we go through a lot of these trades, live. And starting in the next couple of weeks, we're going to do some live trading too. And again, we're not here trying to sell you anything. We're just trying to give you some education. I hope you're having safe trading. I look forward to talking to you soon.